Welcome back. You're watching Stock Watcher with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Drikus Combrinck from Capicraft and Grant Nader from Benguela Global Fund Managers. We are pre-wrecking today's episode, but of course, do continue to send your questions and we will answer them when we are back on live. Thank you so much for your time, gents. Of course, right now, because you are pre-wrecking, the markets haven't closed, but from what we've seen already, we did have a rebound in the Japan stocks actually having their best day. I can't remember, but yeah, since a very long time ago. After the Black Monday that we had yesterday, but really that's not filtering through to the JSE. I also saw earlier on in the European markets, also those failed to rebound. And I'm wondering why that positivity from Asia isn't filtering through to the local market. Drikus, I want to start off with you.
No, firstly, the carry trade, the yen carry trade, that's actually unwinding at the moment, or partially unwinding. That is quite large. Some estimate it's as large as $4 trillion. Now, that will take its time to work its way through the financial system. With that, you've got, only that's the first order effect. You've got second and third order effects of that. The second order effects will be that as shares get sold down, the day after or the week after, companies, or let's say hedge fund companies, will open their books and the risk models will tell them that they need to close down. They need to, volatility has increased. A lot of strategies is based on what the recent volatility has been, and the risk models will tell them to decrease their positions because the vol has increased. So that's what's happening at the moment in the background. At the other side of the trade will be bargain hunters, because, there's definitely some bargains coming out as well. You will see bargain hunters coming back into the market. And and the third order effects will be if this continues. If there's a general panic, I don't see that happening for now. But that will, if the sell-off continues, then you will see that having a knock-on effect on the real economy. The American economy is very financialized. So if they see their 401ks going down, if they see their portfolios going down, that will definitely have the effect on consumer spending in the US. And you might see that, affecting the real economy. Not as badly as it would have otherwise been, because we still have about $500 million or so of the Inflation Reduction Act that still has to be spent over the next let's say 12 to 18 months.
Well, I mean, we haven't really seen the bargain hunting locally. Do you think that maybe, Grant, we could have a kind of investors going for these, specific sectors like AI, for example, and that's maybe where we're going to see a lot of the buying, and maybe not necessarily in the broader market?
Well, if you're talking about locally, I mean, we've been a very defensive market. If you look at our index, it's outperformed most indices on the sell-off. And I think there's a number of reasons. One, we've obviously got a little bit of a rand hedge flavor to our market, which has helped. But then also we've got quite a lot of South African stocks that are facing an improving outlook, but are actually not yet that expensive. And so there's this, we've almost got this little self-help story going on in South Africa, and I think there's a lot of money on the sidelines that would still love to be buying into SA and into that story. And so there is, I don't expect to see anything like the kind of sell-off we've seen overseas in SA. So I think there's a bit more support around for our market, even though there's been some pullback. A lot of the good stocks have hardly pulled back at all.
Just on that, we do have a question here. After Intel came out with negative results yesterday, I think we are yet to see the AI bubble burst, because all chip stocks are swimming in blood after a rapid rally. Is it too soon? I don't know if the viewer is asking, is it too soon for the bubble to be bursting? What are you making of the AI bubble right now? And I guess the pressure that the AI stocks had seen yesterday. Do you think that this is a popping of the bubble, Drikus?
Yeah, so by AI bubble, I guess you'd include all the let's say all the semiconductor stocks like Nvidia and Intel, which you just mentioned, TSMC, etc. So, yeah, we never know what pops the bubble. Let's say let's just regard this as a bubble for now. The valuations are stretched. That's a fact. How much bigger a bubble can get before it gets, no, I don't know. But let's say that the bubble has burst. How much downside is there? That's actually what you should be asking at the moment. Would you, even if you're bullish on AI, would you be buying at these levels at valuations that are still pretty stretched? I just had a look at Apple. I think that is still about a 30-something price earnings ratio, even after the drop. I didn't even look at the free cash flow yield. So what a lot of these companies have done is, the Magnificent Seven, they're each other's customers, right? To a large extent. So what they've done is a lot of them have ordered chips. They're putting that through as capex. It's not going through the income statement. That's capex on their balance sheet. It's an income on the others, like Nvidia, other Magnificent Seven company. It's an income, on their income statement. So there's a clear mismatch. So going forward, that income might drop if orders drops off from Nvidia. Plus that capex, you'll have some depreciation coming through on the income statement as expense going forward. So I think we might have seen a peak, maybe a short-term peak, and what we in the capex cycle. The capex cycle in semiconductors, etc. These stuff. This is cyclical. This is the capital cycle. It's cyclical. So I don't know. I've been out of this stuff for quite a while. I've missed most of the rally. Maybe it's just a bit of a sour grape stalking. I don't know. To be honest with myself, missing that train. But I just can't get excited at this moment. It has to drop a lot before I will get excited about it.
Okay. Well, yeah, that's really, I guess, the question. Grant, do you think that we are still in a bubble, and how much will it take for it to pop?
It is a good question, and many market participants are asking the same question. I think, look, there's definitely been valuations have expanded dramatically, and some things definitely have behaved in a bubble-like fashion. And so I think there's a bit of right sizing that's happening, and I think that's a very good thing. But underlying that, I do think there are some structural trends that you're not going to see. This is not the end of the capex cycle. It's not the end of the AI rollout, but perhaps it's just being a bit more normalized, and it's going to take place over a slightly longer period of time. And everyone was bringing forward so much revenue expectations that I think now maybe they should just temper a little bit, maybe be a little more selective about buying what you're buying, and look for some earnings there. And I think it's still very much in play, but you have to be careful about chasing these valuations, because you can get burnt. So, if you like something, maybe, and it's had a 30% pullback, you can nibble, buy some, but don't put your whole money, all your money to work. Sit back, look at what's playing out, and then you can invest, over a period of time is what I would suggest. I don't think, as I said, I don't think the story's over, but I do think you need to be careful. Just kick the tires on everything that you want to buy, and if you're going to buy anything, just don't overpay. There is definitely some level of hype that's been baked in.
Yeah. Well, I mean, just extending on those jitters, there's a question here. The non-farm payrolls report came in with a steady 3.5%, indicating strong labor market, but also missed estimates due to lower job growth in the manufacturing and retail sectors, matching the June revised figures. It seems like recession is knocking. Of course, that is what the fear is about. I assume that is the reason why the Fed keeps on procrastinating on rate cuts. U.S. national debt is standing on $34 trillion, indicating a huge debt exposure. This is leading now to this question: is China still not good enough because it has already hit the bottom? So I guess the viewer is really just talking about how, I guess, things are looking bad in the U.S. In light of this, because a lot of people have been investing in the U.S., but in light of this, is China still not good enough, considering that he's assuming that it has hit the bottom? Drikus?
Look, the data out of the US is not inflationary yet. Sorry, the hard data isn't. The ISM manufacturing figures last week have to take with a pinch of salt. It was in the month it was conducted in the month that Trump was almost assassinated. Obviously, sentiment is going to be rocked for half of the population. The ISM services, on the other hand, was released yesterday, was much better. So that's 80% of the economy, of the US economy. Secondly, the Chinese, most of what we're seeing in China is allowed to happen. They're trying to, let's call it, rebalance the economy or whatever. They're so concerned about moral hazard, something that the West has forgotten, that we never learned after the GFC, but they're concerned about moral hazard. They don't want to be bailing people out too soon, but when push comes to shove, they will be bailing people out. Actually, if you look at the yuan USD crossover, you'd see that the yuan has actually strengthened last week. Just something that I noticed. But yeah, and then thirdly, so soft data, you can't trust in this election year. This election year may be an outlier. Sentiment towards politics hasn't been as sour in our, at least for a generation. And then with regards to the unemployment figures, is you can't trust that with all the immigration coming in. Immigration level that has come in over the last year or two has pushed up the amount of job seekers.
Yes.
And that obviously has an effect on the unemployment rate of 4.3%. It might overstate it by a bit. So yeah, it's not too sure. The waters are very muddy at the moment with regards to the economic figures, but they are soft enough to give the central bank, the Fed, leeway to cut interest rates. And I think that's the main point. And all of a sudden, you've got the Japanese increasing a bit. You've got the US decreasing a bit, maybe in the coming months, and that narrows that carry trade and a reversal of capital. So this is mainly a reversal of the carry trade, first and foremost.
So Drikus, I mean, it's quite interesting that you talk about the fact that we should look at these employment figures, from a responsible perspective. Would that then make recession fears a little bit too overdone at this point?
I think so. There's no recession at the moment as we speak. But, there's a thing called reflexivity in markets. And if markets can be self-fulfilling. So if there's a big enough sell-off in the markets, because the economy is so financialized, it will impact financial conditions to a large extent. And people will stop spending, especially in a very uncertain election year, where people are staring down each other's throats. So that will have a major effect in this year, and then it becomes a self-fulfilling prophecy. So I'm always aware of that reflexive nature of markets, but at the moment, it's not. The data isn't screaming recession. It may indicate that the chances of a recession has increased. Absolutely, in coming months, but we're just not there yet.
Grant, do you think that we will start to see a moving of feet from the US to the Chinese stock markets, considering these recession fears in the US and the viewer saying that maybe China may have hit the bottom?
I think so. Just for the context, I agree with Drikus. The recessionary outcome is not a base case for the US at this stage. Yes, the odds are rising, and there's certainly some risks under the surface, but I don't think we should assume that's what's going to play out. And then the second thing is, if you're looking at China, yes, China is really cheap at the moment, but it is cheap for a reason. There's a lot of regulatory uncertainty. There's been a lot of market intervention. So a lot of Western capital has left China as a function of geopolitics, as a function of the government meddling in the economy. Plus, they've got their property sector they need to sort out. Consumer confidence is a bit of a mess. So China certainly offers value, but it's not clear how and when that value gets unlocked. So at the margin, what you need to see is improvements in China. So China is a massive economy, and it's still growing 4.5% or give or take, which is actually a fantastic growth rate. However, at the margin, things are not really showing an increasing trend. They're showing a worsening trend, or certainly potentially trying to stabilize there. So the government's lack of intervention has got people a bit nervous. They're not following the same playbook they followed for many years, which is just spend their way, in infrastructure and things like that. But they've got a clear plan. I think if you look to invest in sectors that you don't expect government interventions. So the tech sector has become a key pillar of the future growth prospects. You can probably find opportunities there. They have intervened in a number of other sectors. So you have to be very careful. There's a lot of hidden risk in China, and certainly there's value that warrants looking at, and we do and invest in some areas in China, but it's with a bit of skepticism, and one has to be a bit careful. I don't think you'll see a mass inflow into China at all, as long as the global geopolitics remain as they are.
Yeah, right. Well, gents, let's come back home. There's a question here on Pick n Pay. The panel's view on Pick n Pay and when the Boxer spin-off is going to happen. Isn't that towards the end of the year, if I remember correctly? But your thoughts on Pick n Pay, Drikus?
Yeah, I think it's going to take more to get back. It's one thing to stabilize your balance sheet. It's another thing to take back market share. It's going to take another few billion in capex in a few tough years, lean years, and it's going to take a lot of other decisions, to turn this one around. I'm just not seeing it, not because it's not enough. I think that they're doing plenty, but they're doing it against a very, very competitive sector, and we've got a big gorilla in the sector that knows how to pull punches. So, yeah, maybe it's cheap enough at these levels to warrant a buy in any case. But I'm just not convinced.
Very interesting observation there that, stabilizing the balance sheet is one thing, but also now gaining market share is another thing. The second part of that question, Grant, is I don't know if you can really compare these two, but preferred stock between Pick n Pay and Pepkor.
That is a tough one. I think at this point in time, I would definitely lean into Pepkor. I think they're playing into the lower LSMs in the market. It's a little more defensive. They've lower price points. They've got a clear business model. They understand where they're playing, and they're good operators. And they don't have anything resembling the kind of challenges that Pick n Pay has. If we see an improving macro outlook in SA, which we think we will, Pepkor is a good place to be to benefit from that. You can look at even the two-pot system, which will benefit the lower sort of income areas of the economy. That should see some uplift in spending there as well. I definitely would prefer Pepkor over Pick n Pay. Having said that, I think that Boxer is a good business, and I think that's worth having a look at once they spin off, but I wouldn't be rushing into Pick n Pay anytime soon.
All right. Well, let's get into BAT. Your view on British American tobacco after recent rally as global markets shift more towards value over a risk on sentiment. Is there still room to run, and has very attractive yield and still looks cheap? Drikus, BAT?
Yeah, well, I agree with the viewer's assessment there. It's not a position that we carry in general, but I think there's still good value there, especially if there's the soft patch in global data we have continues, especially if interest rate cuts does come through and you get a 10-year bond yield that's say below 4% if it stabilizes there. The UK has just cut, it's listed in the UK. So if we just get slightly lower interest rates for the time being, it's a defensive asset in a difficult market. I think the share price should do well. I think most of the fears around the combustibles, the legacy products, etc., that has stabilized to a large degree. It's been the company has cannibalized itself to a large degree with the new products, and those are growing rapidly. A very, very large proportion. Luckily for them, or sadly for society, I don't know. Don't make your own decision. A very large portion of between 16 to 35-year-olds are vaping these days. It's a large proportion, and they won't stop easily. So they've got they discovered a new market, and that market is growing rapidly.
Grant, would you be smoking or blowing in BAT's direction?
Yeah, I think, actually Drikus hit the nail on the head. Understand what it's giving you in your portfolio. You're not going to get significant growth. You're not going to get significant upside in this one, but it can sort of sit there and hold its value. It'll pay you a nice dividend, and it'll be a good rand hedge if you're looking for a safe place to to sit in your portfolio. But is it a sort of an exciting stock? Does it have great opportunities in front of it? Not yet. And I think the e-cigarette space is exciting. It is growing really fast. The uptake is frightening, actually, and it's starting to get scale. So that could be a growth area that perhaps isn't in the price, because the stock is very cheap, and it stays cheap as long as you're seeing kind of low single digits growth in revenue and a few extra percent in earnings. I mean, those are the kind of only levers they have to pull, is around the price mix. So it doesn't excite me, but I don't think it's a terrible place to invest right now, especially if you're a bit concerned about the outlook in the sort of medium term.
All right. Well, a very interesting question here. View on gold stocks after recent correction. Is it a buying opportunity with rate cuts looking looking like they're coming, or are they fairly priced after a successful rally this year? Drikus?
No, I think gold stocks are undervalued compared with the gold price. Gold miners they've done really poor capital allocation decisions over the last 2 decades, and maybe they deserve to trade at a low rating. But I think that's definitely looking better. I think a lot of them, let's say for instance Anglo Gold, I think has really made some proper decisions the last few years. And no, I think gold, if the gold price stays here, these stocks are extremely cheap.
And also the second part of that, preferred gold miner, Grant, if you have one.
Yeah, I would have leaned toward Goldfields, but they really haven't done a very good job of ramping up Solaris Norte, etc. But if they get that right, I would lean toward them. I think their cost of production is coming down as they ramp up their volumes. So none of them are operating that well at the moment, but I would lean to Goldfields with a longer term view.
All right. Would you have a preferred gold miner, Drikus?
We've had Pan Africa for a long while locally, as well as GFI, Goldfields. I think most of the problems are behind them. Hopefully they find no more chimchillas or whatever in the area that they're supposed to mine. Not the only problem, but yeah, that was quite ridiculous.
Yeah.
But and we've had Anglo Gold as well, and then we own the GDXJ, the Junior Mining Gold Mining Index, and a few royalty companies as well.
All right. Well, gents, let us get to your stock picks for today. Grant, what are you picking?
So my stock pick on the theme of technology is ASML. It's the Dutch semiconductor equipment maker. The reason I like this company is they basically have a monopoly on semiconductor lithography equipment, which is a key component in actually making chips. And especially as the chips get more and more advanced, the cost of these machines, I mean, the latest generation sells for about 300 million euros for one single machine. They have a complete monopoly on this market. So I think over the next 3, 4, 5 years, the growth, the demand is there, the growth is there. It's had a nice 27%, 28% pullback from the highs. And I think fundamentally it's an incredibly good business. And so that's my stock pick of the day, is ASML.
Yeah, all right. On your side, Drikus?
Yeah, one in the Nikkei for you after the crash. It's down 23% in the last 3 days. It's called Yokohama Rubber Company. Is it Yokohama Rubber, or is it? I always forget, but it's Yokohama.
Yeah.
And the company basically produces tires, conveyor belts, etc., all rubber products. It's trading at a single-digit PE, and at the EV/EBITDA forward of about 3.5, 3.7, I think, after the recent fall in the share price. A lot of cash on the balance sheet, solid balance sheet, like most Japanese companies. And not only because it's cheap and because it's fallen 23% in Japan, and you need some Japan in your portfolio, whatever. No, I'm very bullish rubber. So that's one of my ways that I'm playing the rubber story.
All right. Well, thank you so much for your time and for your analysis today, gents. Much, much appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Drikus Combrinck from Capicraft and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay tuned.